3:15 on this Thursday. Stocks surging today on news that China is not abandoning Europe during its credit crisis. That worried the markets a little bit yesterday. But can the rally going forward be sustained? Well, joining us right now is Keon, Managing Director at Quantitative Management Associates. That's a division of Prudential Financial. He's been a market strategist for about 20 years, currently oversees a team managing $30 billion in assets. Ed, great to have you back with Matt and me on Street Smart. Let me ask you, do you think that this rally can be sustained going forward?
I think ultimately it will be, but there are two opposing forces which are directly opposite each other. The first is it looks as though the U.S. economy and corporate earnings really are recovering. The bad news is that problems in Europe and elsewhere around the globe have been worrying the markets that the risk premium needs to be bigger than it has been. So in the last month or so, the risk side has been winning, but ultimately we think that the strength of the economy will turn out to be the more important factor.
Is there another shoe to drop, you think, Ed, in Europe? Do we hear about more downgrades coming up? Do we hear about more possible defaults here?
I think the answer is almost undoubtedly there will be a lot more bad news before this is fully resolved. If you think about it, in the United States, we started to get bad news in late 2007. It really wasn't until March of 2009 that the equity market bottomed. So you can expect probably to have a give and take over the next several months as Europe tries to finally contain this overall problem.
But Ed, is it just a give and take? And we've had some viewers, email in about that this is not just a thing that's going on in Europe. It's a bigger story here, financial crisis part 2, if you will. Are we all just kind of brushing this off too quickly? And it sounds like you might be.
Well, actually, I think that's a good point. I've been suggesting over the next decade or so, we should expect a lot of turbulence. And I think the long-term issues that are clearly now evident in Greece are true, as many people have pointed out, in many other countries around the world, including the United States. So we're going to go through a painful adjustment period over the next decade or so as people and governments adjust to the too many promises made to too many people with too few resources to meet them. That doesn't mean that stocks necessarily have to have a terrible decade, because as long as corporate profits continue to grow, we'll be okay.
Haven't they just had a terrible decade? Because they haven't done too much in the last 10 years.
Well, and of course, you never know exactly what's going to happen again. But the market over a long period of time tends to be mean reverting, meaning when it's done great, it does poorly. When it does poorly, it tends to do well. So partially why we had a lousy decade was we had two great decades before that, the two best in market history. So my guess is, and it's still a guess, is that we are adjusting to a slower growth period, but valuations are low enough, and the ability of the U.S. economy and U.S. companies to grow are still good enough that I think we should expect a decent, although maybe not historically average, returns over the next several years.
Ed, let me say, last time you were on, I felt you were pretty bullish. You were talking about $100 for corporate earnings in 2011 at a P of 15. You said 1,500 on the S&P, pretty easy to hit in the next year or so. Do you still feel so optimistic about corporate earnings for 2011?
I do. I think that earnings are going to recover at a pretty good pace. Now, the strength of the dollar will be a bit of a negative, so that 100 might be a little optimistic. But my guess is that we will continue to see that the domestic U.S. economy will strengthen, and that U.S. companies will continue to gain profits from around the world. And I think over the next couple of years, we probably will get to something in that 1,500 range.
What about you say we're in the beginning of a positive economic cycle as well, from what you saw, talking about retail sales, talking about household survey unemployment, talking about housing. Do you still feel that way a month into the European crisis, its effect on our markets, and after the GDP reading that we got today, also a little bit worse than expected?
Yeah, the GDP number for the first quarter was just slightly revised down. But I think if you look at the more real-time data over the course of the last month or so, actually it's been quite positive. Just within the last week or so, you got a good reading out of consumer confidence, which, among other things, suggests that people are starting to see that it's easier to get jobs than they had in the past. We got a pretty good durable goods reading today. So I think the economic data continues to be supportive of a pretty good economic recovery.
But Ed, you don't see that U.S. economic data potentially breaking down over the next 6 to 12 months somewhat because of the situation in Europe?
That's possible, certainly, but I think the best case is it probably will not. It'll take a while before whatever contagion there is from Europe reaches our shores. So I think 6 to 9 months is probably a little bit too quick, first of all. And second, even though the issues of how to deal with them in Europe are very acute in places like Greece and soon Spain, and the bigger economies, which are bigger influences on the U.S. economy and U.S. corporate profits, growth is still positive, although fairly weak.
All right, hey, Ed, thanks so much for joining us. Ed Keon there of Quantitative Management Associates.